This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Businessweek Daily with Carol Massar and Tim Stenovec, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
And we are up on this Friday. Welcome, everybody, to Bloomberg Businessweek Daily. It is Friday, February 6, 2026, and what a week it has been. We're not quite done yet. Today, investors are back. The S&P headed toward its best day since November. Small caps on fire, and Bitcoin, a little bit of a bounce back.
Yeah, up 10% right now. 69,720 is what we're seeing. I guess everything's okay now?
Everything is awesome. What could go wrong?
Yeah.
Actually, we're going to talk about all of this.
Not everything is higher.
No, because tech stocks, you look at the NASDAQ 100 higher. Amazon, Alphabet, Meta, you and I were talking about this. You look at the Mag 7. These guys are not doing well. They have been selling off, so we're going to get into that. Also selling off, Homebuilders on a possible action by the White House. More on this Bloomberg exclusive and the trade in just a moment.
Our mega cap earnings season roundup. And now, look, we got Mark Mahaney stopping by, Senior Managing Director and Head of Internet Research over at Evercore ISI. He's going to be joining us in just a few minutes.
All right, looking forward to that. Looking forward as well to Greg Daco back with us at EY on how those three AI pillars are doing amid the AI spend and impact worries. We're also going to talk, this was supposed to be a Friday jobs report. We'll get that on Wednesday because of the brief government shutdown. So we'll see what he has to say about the labor market as well.
And finally, view from the C-suite. Greg Hart, the CEO of Coursera, is going to be joining us a little later this hour,
Are we
too.
a little tired?
I'm good. I'm good.
It's been a week, everybody.
Yeah, I'll talk to you at the end of the program today. We'll see.
Exactly. We'll see how we'll go. Hey, do not go anywhere. Great 60 Minutes coming your way in just a moment. Right now, though, a check on the trading session with Charlie Pellet.
Hi, thank you very much. Here's what's going on. Stocks definitely rebounding. What a different tone to this market compared to this time yesterday. Get out those Dow 50K hats because we got the Dow Jones Industrial Average, 49,946 right now, looking at an advance of more than 1,000 points, up 1040 right now. That is a gain of 2.1%. S&P 500 index up 113, 69.12 where we stand there, up 1.7%. NASDAQ up 420, up 1.9%. Our Mag 7 index, little changed right now, up under 0.1%. Small cap surging. The Russell 2000 index of small cap names up 3.3%. The VIX, 18 even. 10-year, 4.20%, with the 2-year, 3.49%. Gold up 183, up 3.8%. Silver up 9%, 77.30 the ounce on silver. West Texas Intermediate crude up 1%, 63.89. And Bitcoin, major story there in terms of the rebound, was back at 70,000 right now, 69,915 on Bitcoin, up by 10.8%. Techs, however, many techs selling off. We'll talk about that on Bloomberg Businessweek Daily. We've got Amazon down now by 6.2%. Shares dropping after the company announced plans last night to spend $200 billion this year on data centers, chips, and other equipment. So Amazon down 6.2%. Alphabet down 1.8%. Microsoft up 1%. Meta Platforms among companies with big CapEx spending up now by 1.6%. Again, recapping, S&P up 1.7%. Bitcoin up 10.9%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Well, shares of U.S. Homebuilders taking a hit earlier in today's session at their low today, intraday low, down about 1.4%. They've moved off that level, just slightly lower as we speak. In a Bloomberg exclusive, the Trump administration officials are exploring opening an antitrust investigation into U.S. home builders as the White House sharpens its focus on tackling the country's housing affordability crisis. This story definitely caught our attention.
Yeah, with us is Bloomberg News real estate reporter Pat Clark. He joins us here in the Bloomberg Business Week studio. Congratulations on another exclusive when it comes to the White House and housing affordability just this week. What can you tell us? What are these possible antitrust concerns?
Well, the thing that, one thing that's caught the eye of administration officials is a trade group, and they're concerned that, our home builders coordinating through the trade group. And that's a thing that's been raised, at least internally. I think that's a common concern about trade groups across industries.
Coordinating how?
Well, you're not supposed to talk about like
anything.
We're going to set our prices in this way, and you're not supposed to tell your competitors how you're setting prices, and I think it's a concern that can come up, which is like you have this trade group where everyone is getting together and talking to each other, or they're talking to some centralized person in the trade group, and information gets disseminated. And this would not be. I'm not an antitrust expert, but my understanding is that this would not be the first time that there was a probe of a trade group or some centralized body.
The leading builders of America is the trade group. What have they said? What have the homebuilders come out and said after this?
They haven't responded. They're keeping their heads down right now, or so it seems. I think, all this goes back to October when the president put out on a social media post that home builders are, he likened them to OPEC and complained that builders are sitting on more lots than ever. And, I think this is, if you go back to the story earlier this week about the builders' pitch for a Trump Homes project, in a way, that's like trying to get on the administration's good side in hopes that, they're not on the bad side. And this is kind of what the bad side might look like.
Just last question. Kudos to you. Two exclusives in terms of what the White House is working on housing affordability. Having said that, they are said to be trying to do anything. Is there any progress, any really move forward in terms of being able to make homes more affordable? Some would say there are different issues at play in order making this work, but in terms of what the White House might be able to do.
Listen, I think this is where we are on home prices. It took 15 years to get to this point. It took a pandemic, to get there in the end of an interest rate environment that had been in place for a decade or so. So, I don't think the standard should be getting to, a solution overnight. But
yeah.
It's in those, something is going to, people are talking about things. What happens, I don't know.
Is it really a priority for the White House? Just quickly.
Seems like it.
Okay, good stuff. Pat Clark, thank you so much. Busy week or so for him, real estate reporter at Bloomberg News here in our studio. Tim, we're going to stay on the domestic economic state because we did get some data earlier today.
Yeah, that data showed that U.S. consumer sentiment unexpectedly improved to the highest in 6 months, largely propelled by wealthier Americans who've benefited from stock market gains. Digging into the U.S. economic backdrop, Federal Reserve Bank of Atlanta President Raphael Bostic reiterated it's important to keep interest rates at a level that restricts economic activity and returns inflation to 2%. He spoke about that and more in an exclusive interview with Bloomberg TV and Radio's international economics and policy correspondent Michael McKee. That was earlier in Atlanta.
In terms of inflation, what I've learned is that we really don't want to have inflation. Right? Once inflation gets entrenched in people's minds, it changes how the economy evolves. And it's one of the reasons why I think that we need to keep our policy in a restrictive posture so that we get inflation back to 2%. That's paramount. High prices and the prospect of rising prices really do have a lot of families on the edge. And you all have reported a lot about the K-shaped economy. There are lots of families that are feeling very precarious right now, and that's a source of concern.
Do you think the economy is becoming more K-shaped?
I don't know more. It's been that way for a while. Just before the pandemic, I had been talking about this, and we were trying to find some metrics to really detail how there's a split. I used to call it the barbell economy, where either you're at the high end or at the low end. The K-shape is the same thing. What I know is that there are a lot of families that are precarious and are feeling very uncertain about their prospects for the future and the prospects for their children, for that matter. And that concern, I think, does underlie a bit of the lower on the low consumer confidence that we continue to see being reported. And what we'll need to do is really give people reasons to be optimistic, show them where the new jobs are coming from, and show them how they get the skills to compete for it.
Well, this week, Treasury Secretary Bessent said the Fed has lost the confidence of the American people. Do you think you have lost the confidence of the American people? In your district, do you hear people raising questions about that?
That's not been my experience. As I go around the 6th District, people tell me, we're grateful for what you're doing. You have a very hard job, and we want you to be as data dependent and as open to information so you can make the best judgment that you can. Look, the world is very complicated. It's actually more complicated today than it has been my whole time here. So what I think most people understand that, and they know that we're doing the best job that we can under very difficult circumstances.
All right, that, of course, is Fed Bank of Atlanta President Raphael Bostic in an exclusive interview with Bloomberg TV and Radio's own Michael McKee earlier from Atlanta. Here to get into the economic macro situation, if you will, what faces the Fed and so much more. Some of the things we just talked about. And great to really have back with us. And it's not a Jobs Friday, which I have to keep reminding everybody, which kind of blows my mind. Gregory Daco, he is chief economist at EY. He is here in studio. Welcome back.
Pleasure to be here.
There's so much right even there, housing affordability, and then kind of the bigger, broader of what the White House does to help the U.S. economy and more Americans. There's Raphael Bostic talking about Fed confidence, 2% inflation, important to make sure that we have inflation under control. What's important, and a Jobs Friday, where it isn't a Jobs Friday, but we'll get that read. When you think about the U.S. economy, what is front and center for you?
Well, I think it's the paradox of having strong growth, but underlying weakness across different sectors and across different stratas of the economy. I don't really like the K-shaped format because it tends to signify that there are two groups of consumers. There are two groups of businesses. The reality is that there is polarization across the U.S. economy. Mm-hmm. Whether you're looking at certain income groups, not just the lowest income groups, but the median income groups, they are increasingly struggling with high prices. When you look at business investment, there is polarization between those that are focused on AI investment and those that are not. There is polarization between large businesses and small businesses that are struggling more in the face of some of these policy headwinds. So it's not necessarily a K-shaped economy as much as it is a polarized economy within which you're still seeing strong averages. Average consumer spending still doing well. Average business investment still doing well. Average GDP still doing well.
What's that masking, though?
I think
taking the average is just that. It's the average.
It's
there are outliers.
Yeah.
And so what's it masking?
It's masking an underlying fragility in the fact that you have these narrow pillars of growth that I've talked about in the past. And I think if you bring it back to income, which is really the fundamental pillar of economic activity, that is where there is pressure. The income growth for consumers is relatively low. We're talking about 1% growth for real disposable income growth, while consumer spending growth is at 2.5%. That explains why the personal saving rate has fallen 2 percentage points since April and the early implementation.
There's nothing left to spend, to save, rather.
People are dipping into their savings.
Yeah.
They're using credit. And that's why I'm a little bit more cautious than others when it comes to this notion that there will be a lot of fiscal stimulus during the tax refund season. Yes, tax refunds may be higher, but what is this money going to be used for? Is it going to be used for spending or reimbursing some of the credit and replenishing savings?
Listen, we've talked with you too about the wealthier consumer, and you get into the A pillars or the 3A pillars. We had consumer sentiment come out today, improved to the highest in 6 months, largely propelled by wealthier Americans who have benefited from stock market gains. So, yay, good. We know the wealthier consumer is very important to the U.S. economy. But I am curious what was going through your mind this week. We were kind of talking about it amongst ourselves with the AI trade a little bit in question and some nervousness around that. We saw that play out. That has been important to stock market wealth, especially among the affluent. So I'm just curious, should we be a little worried that this could come undone this year?
We should be very careful about the potential of an AI bust. This is a real downside risk, and it's interconnected with other potential risks to the U.S. economy. We're seeing a great degree of focus on the fiscal situation. We're seeing a great degree of focus on pressures on the Fed. Why do these matter? Because they can suddenly lead to changes in financial asset prices. And we know how the financial market has been behaving over the course of the past 18 months. A lot of gains on the equity front, but also a lot of movements across different asset denominations, a lot of movements into gold when things are not going well, not so much treasuries and not so much the US dollar. So these are important developments, and everything everything happens together. And so if we are to see a little bit more of a downbeat sentiment in terms of the prospects for AI, and importantly, the return on investment, then that could metastasize into something that is worse for higher wealth individuals and their spending desires and spending capability if you see a negative hit on financial markets. It could lead to some businesses pulling back on AI investment. We saw just today the 4 largest hyperscalers are promising to invest a lot in the US. What if that does not materialize? Is there a downside risk there?
Yeah, Amazon just saying yesterday $200 billion. It's $60 billion more than analysts thought they would spend in 2026. So when you say we have to be careful about an AI bust, how does that manifest? What exactly does that look like? Because as Carol was referring to, it's been kind of a complicated week when it comes to really just tracking what these companies have done, or the stocks at least have done, because there's this concern about a SaaS apocalypse with the software as a service companies as a result of what Anthropic's Claude was shown to do this week. And then there's also the concern about some of the hyperscalers and spending. So when you say AI bust, what does that look like?
Well, I think we're seeing a lot of pragmatism right now. We're seeing this notion of economics of necessity. What is necessary to drive growth? Where are going to be the next avenues of growth? And I think not many people know, and very few actually know what the situation will be in a year's time, 2 years' time, when it comes to which sectors will be leading the way. We're in the midst of a technological revolution. There are always going to be excesses in terms of upside risks that are taken and downside risks that are taken.
So we're definitely in the midst of this.
We are in the midst of an AI technological revolution.
And it's interesting because Amazon CEO Andy Jassy told investors he's confident the company is going to see a return on its massive investments in artificial intelligence. Listen, these guys have fiduciary responsibilities, right, when they make these spends. So I guess to some extent, you've got to trust that whatever he's seeing, he feels comfortable enough to say that, right, and doesn't want to put his company or his share price or any of this at risk. But again, people will also say, well, these people are talking their books. I mean, like, this is a big thing for them. So it's a hard thing to kind of weave through to figure out what's really going on.
You know, when I say narrow foundation to growth, one thing that I find really amazing is that the announced investment in CapEx from these 4 largest hyperscalers is worth about $250 billion. Assuming that materializes over the course of 2026, and assuming only a fourth leads to stronger economic activity domestically, so that 3/4 are imported, not necessarily counted in GDP, that would lead to a lift of GDP of 0.2%. That's a significant boost from 4 companies, right? So that is where the narrow foundation to growth is lying. You're seeing a lot of growth that is reliant on a few actors in the economy, wealthier individuals and larger firms,
right.
And smaller businesses and lower income families are increasingly struggling. And where I start to worry a little bit is that we're seeing this bifurcation between the prospects for strong productivity growth, but not necessarily the accompanying income growth that usually accompanies a strong productivity cycle. And that's because of this polarized economy.
That's a great point. Like, if we're more productive, where's the income to go?
Usually that's the story. You get more productivity and more real wage growth. You're not seeing that right now.
Hey, just in the last 40 seconds we have with you, on any normal Friday at this time, we'd be talking about the labor
How many jobs?
Right? Yeah. Well, what does your analysis tell you about the health of the labor market right now?
And just have about 30 seconds.
It's in balance, but it's a fragile balance because we've seen a historical negative shock to labor supply from reduced immigration. So we have a break-even rate that's close to zero, but we are seeing labor demand being hesitant. Business leaders that we speak to are very hesitant as to who they hire, what skills they hire for, and at what salaries. And that is downward pressure on income, which in turn will feed into softer consumer spending going into the rest of the year.
Slow to hire, slow to fire. Is that what they say? Or what is it? What's the expression?
Yes,
low hire, low fire.
Oh, low hire. Yeah. Greg Daco, thank you so much.
Always a pleasure. Thank you.
Our pleasure as well. Chief Economist at EY. Coming up next, we've been talking about the big tech spend as the AI race intensifies. Problem or potential and possible payoff, or winner takes all. We have so many questions. We're going to put those questions to Mark Mahaney over at Evercore ISI. Do not go anywhere. This is Bloomberg.
It's 2:21 on Wall Street. We do check markets all day long here at Bloomberg. I'm on 50K watch. We are just 10 points away from Dow 50,000. The Dow, the S&P, NASDAQ, all surging. S&P 500 index up 113 right now at 69.11. That's a gain of 1.7%. The Dow, though, up 2.2%, up 1,084 points as I speak. 7 points away right now. 49,993 on the Dow Jones Industrial Average. We've got NASDAQ up 407 now. NASDAQ Composite up 1.8%. NASDAQ 100 index, full of those big tech names that we'll be talking about in a moment, up by 1.8%. But interestingly, though, the Russell 2000 index of small cap shares, it is the outperformer today. Right now, we have got 50K, by the way, 50,000 on the Dow Jones Industrial Average. Big round number, yes, 50,002 right now on the Dow. We've got the Russell 2000 up 3.3%, the 10-year 4.20%, spot gold up 180, up 3.8%. We've got silver up 9.2%, Bitcoin up 11% at 70,048 on Bitcoin. The big story, though, Dow 50K right now, happening as I speak. Dow Jones Industrial Average at 50,004, first time ever a record. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, super appreciate that. As Charlie mentioned, the Dow hitting the 50,000 mark for the first time ever. It's up about 2.25%. It's not an index that we often kind of focus on, but nonetheless kind of remarkable where we are today. 1.7% higher, as Charlie mentioned, on the S&P 500. And the NASDAQ 100, Tim, up about 1.9%.
Yeah, I mean, and the reason we don't talk about it much, it's a price-weighted index of individual stocks, so the biggest movers aren't necessarily the biggest companies. That said, Caterpillar, Goldman Sachs, JP Morgan Chase, Amgen, and NVIDIA are all pulling the Dow higher today.
Which is kind of interesting, right?
Yeah, three lower in it, Amazon, Verizon, and Visa.
Well, I just want to bring up the Mag 7 because we've been talking about that too, and we have seen that index where some of the usual gainers, especially when the tech trade is higher, but you've got Amazon, not participating in this rally. Amazon is down about 7%, Alphabet down about 2%, Meta's down about 1.4%. They were down all a lot earlier in this session. Hey, one of the things we wanted to get to was one of the most read stories on the Bloomberg today. Four of the biggest U.S. tech companies together have forecast capital expenditures that will reach about $650 billion this year, which is really kind of a mind-boggling tide of cash earmarked for new data centers and all the gear that is housed within them. That is the spending plan by Alphabet, Amazon, Meta, and Microsoft, all in pursuit of dominance in the still nascent market for AI tools. Is a boom without a parallel this century. No doubt about it, Tim.
Yeah, it's a lot. Okay, it's a lot. Look, we're talking about Alphabet, Amazon, Meta Platforms, and Microsoft. Each of these companies' estimates for this year expected either near or to surpass their budgets for any of the past 3 years combined. The investors over the past 2 weeks have reacted to the news differently when it comes to earnings and quarterly updates from these companies. We got a great voice joining us, Carol, who studied these companies for a very long time.
Curious to see what he has to say. Mark Mahaney is with us, Senior Managing Director and Head of Internet Research at Evercore ISI, author of Nothing But Net, 10 Timeless Stock Picking Lessons from one of Wall Street's top tech analysts. He joins us from San Francisco. By the way, he's got an outperform on actually Alphabet, Meta, and Amazon, all of them. Mark, how are you? Good to have you back.
Good to see you, Carol.
Hey, one thing I got to ask you before we get into the individual companies, something like 50,000 on the Dow, does it mean anything to you when you think about the overall market trade?
I'm sorry. I was surprised by that number too. That's where we were. So
that says a lot.
I guess if I'm honest about it, no.
Fair enough, which is what we want. We love the honesty. Hey, let's get to what has been a trade. Depending on the company reporting, the AI spend and AI trade, some have been punished, some have been not. Any logic to it in your view?
Yeah, I think so. We're going through a free cash flow desert. So there's no question that the level of investments is higher than we all thought, a month ago at the beginning of the year, and certainly a lot higher than we thought a year ago. Nobody that I know of, and I didn't forecast this amount of CapEx spend by the major hyperscalers, the four companies you mentioned earlier: Amazon, Meta, Google, and Microsoft. So I understand the market's hesitation, and what it means is that free cash flow is going to be tested, and Amazon's going to have negative free cash flow this year, first time since 2022. I think Google's going to be positive cash flow. I think Meta is, but these huge amounts of CapEx spend are challenging that free cash flow generation, and investors are right to be concerned. What investors should also, though, focus on is what are they seeing in terms of ROAI, like what kind of returns are we getting? So, Google is ramping up its CapEx by $90 billion. That's actually the biggest dollar increase. But what they gave you this last quarter was an acceleration in search growth, was the fastest that they've had in 4 years. What they also gave you was almost 50% growth in cloud revenue and 150% growth in cloud backlog. That is all generated, or in large part generated, by AI. So there's an example here of a return. And by the way, Google had record high operating margins in the last quarter. Amazon just gave you 24% cloud revenue growth, AWS revenue growth, fastest in 4 years, also with very consistent margins, and the backlog jumped by more than they've ever had in a single quarter, something like 40 billion. So I'd argue that there is an ROAI on these for these companies. I can make the same point about Meta, and I think investors just need to be able to work through this free cash flow trough year. If I'm right that it's the trough year and you're going to have accelerating growth that'll take you into 27, I think that sets up these stocks, given their current valuations, very well.
So Amazon right now is down just about 7% as we speak. You've got an outperform rating on the company, $285 price target. Andy Jassy said yesterday that the money would predominantly go to the company's AWS. Most of it would be for AI workloads. He said, quote, "I think this is an extraordinarily unusual opportunity to forever change the size of AWS and Amazon as a whole. We see this as an unusual opportunity, and we're going to invest aggressively to be the leader." Is he right?
Well, he's right that they're investing aggressively. He's right also that almost certainly this is a huge opportunity. I mean, the market certainly thinks so. We wouldn't be going through SaaSmageddon or whatever, this sell-off in software stocks. Yeah, SaaSpocalypse. We wouldn't be going through that if the market didn't think that some of the innovations they're seeing out of OpenAI and Anthropic weren't potentially, dramatically negative for these names. Now, the market may be overreacting, but the market is reacting. And then I just, ask you all to step back a little bit here. Have we seen material improvements in the products and the services that we use because of Gen AI? And I think if we're honest about it, the answer is yes. You know how much search has improved, like as a product, as an experience, how much better it is. The things you can do now, this is like your Google moment of 15 years ago. Like, what was life like before Google? It's kind of hard to remember. I think we're going to have that same moment. Like, what was life like before generative AI? When you can, and we're still scratching the surface. Like, we still haven't had the task. We haven't circled to the task like great, you give me all this information about a Hawaiian vacation package, but then put it all together and book it for me too. Like, make that. And then I really want a personal digital assistant. I think we're all going to have one, in 3 to 5 years. By the way, Gemini personal intelligence has sort of become that for me already in a pretty short period of time. And the ability for this to improve people's productivities, their lifestyles, if you will. I just think that these are their ability to educate themselves, train themselves, learn new skills. I think it's extraordinary what we're seeing. And so, yeah, I believe in the cycle. I'm sure there's going to be overbuilding during it, but I believe in this cycle. And I think there's a couple of companies that are really going to come out financially much better because of it. And I think these are 3 or 4 of the companies that can do it.
That's where I wanted to go, because reading in, this kind of winner takes all or winner takes most kind of view out there. And that's why these guys are all doing a mega CapEx spend, Meta, Microsoft, Amazon, and Alphabet. Are they right about that? And I do wonder, will there be one leader, or is it going to be enough that all 4 of these, Mark, are companies we will continue to talk about 5 years from now, 3 years from now, 10 years from now?
That's a tough question, Carol. I think we'll be talking about them. The question is whether they're going to be materially, larger from here or not. The advantage that they have is that they already begin with these massive bases of users and businesses and applications. And so you're taking productivity enhancements, productivity dramatic improvements to, massive retail, advertising platforms, entertainment platforms. And my guess is that these large platforms are going to be a lot better. They're going to be more efficient. They're going to have higher margins. They're going to have higher revenue bases than we would have thought 3 years ago. Yeah, the CapEx in 2026, the investments are greater than we would have thought 2 years ago. If we're honest with ourselves, the revenue bases are also bigger than we thought. And the profit pools, not free cash flow yet, but I think that's going to snap back next year. Profit pools are going to be bigger than we would have thought 2 or 3 years ago.
Mark, we've talked about, where you're optimistic and some of the winners, but where are you not optimistic when it comes to this spend? Who ends up losing as a result of this CapEx spend and of this investment?
Well, companies that aren't able to make this shift. The one set of companies I've wondered about are the travel companies. This is an information intensive transaction. I think it lends itself to an agentic solution. I think the average person would have spent 3 hours planning an annual summer or family vacation. I'll think about all the things that go into that decision, and then the booking, and then the checking out alternatives and flights and blah, blah, blah. And I think this is wonderful, opportunity for agentic solutions to really sharpen that, to make the whole planning, booking process a lot better. Booking.com, Expedia, and Airbnb better be effectively and successfully investing in agentic travel and having their own agentic agents on their sites. Because if they don't, then those are companies that I think could be dramatically smaller 3 to 5 years.
And you do cover those. You do cover those three companies too. So
yes,
what are they? Do you think they're doing a good job as of now?
I think so, but I haven't seen the proof yet. By the way, nobody's really put together a great agentic travel experience yet. It's TBD. Yeah. You can use ChatGPT and Gemini, but you come up with great for travel planning, but you can't then you still got to go somewhere to do the booking. Somebody's going to put all that together. I just don't know who's going to do that first, but I think there's a decent chance that Expedia and Booking will do it. But then I step back and think about valuations across these names. And if you're telling me that I'm going to get Expedia at 15 times earnings, Booking at 17 times earnings, Amazon and Meta at 20 times earnings, hey, I'm in. I think those are very reasonable multiples. In fact, I think they're pretty dislocated. So, I think a lot of the fear is already in these stocks.
I was just looking at Expedia. It's down about 17% year to date, and you've got Booking down about 18%. I'm not saying that there's a clear connection, but just putting that out there.
Yeah.
Hey, Mark, just got 30 seconds. As we go through this, there's going to be stops and starts, right? Because we are very early in when it comes to this AI spend and build out.
Yeah, you're right. Yeah, we are still. We don't. Agentic commerce. There's some interesting examples. I love what I'm seeing out of Amazon with Rufus, but I want to see more Rufuses out there. And Rufus can still improve materially. So I think we're still early, but I want to see people closing the loop. In terms of the information and the transaction. You want agentic task agents. There are not enough of those yet.
It's funny. All I can think about is how many people over the last couple of years are like, you got to diversify away from these big, Mag 7 companies. Yet, as you lay it out, Mark, it sounds like they're going to be just even more entrenched in more companies and more tasks that we do at work, at home, and at play. Mark Mahaney, you rock. Have a great weekend.
You too, Kara.
Mark is Senior Managing Director, Head of Internet Research at Evercore ISI. Coming up next, the CEO of Coursera.
It's 2:40 on Wall Street. We do check markets all day long here at Bloomberg, and on a day when the Dow Jones Industrial Average crosses 50,000 for the first time ever, we begin with a report that the U.S. Department of Justice is probing Netflix's business practices. Now, this is according to the Wall Street Journal. The Journal says the DOJ is probing if Netflix used anti-competitive tactics. Right now, we do have Netflix shares up by about 0.8%. Warner Brothers Discovery up 1.7%. Paramount Skydance up by 1.1%. Again, these headlines, developing story appearing right now on the Bloomberg. We'll have more details as they become available. The big stock story, 50K. We told you about it on the upside. Right now, we're under 50K at 49,983 on the Dow, up 1,070 points. That is a gain now of 2.2%. We got the S&P rebounding from yesterday's carnage, up 115 points at 6913 on the S&P, gain there of 1.7%. NASDAQ up 1.9%. The NASDAQ 100 index up 1.8%, and our Mag 7 index up 0.2%. Cannot ignore the Russell 2000 index of small cap shares up right now by 3.4%. The VIX just above 18 with a 10-year 4.20%, the 2-year 3.49%. Gold up 3.6% now at $49.50 the ounce. West Texas Intermediate crude up 0.2%, $63.45 a barrel, and Bitcoin 70,200. Bitcoin surging right now by 11.3%. ExxonMobil and Chevron are expanding production in nations tied to OPEC, including some of the world's riskiest geopolitical hotspots, with help from President Trump's assertive foreign policy. ExxonMobil today on a day when stocks are ripping higher. This Dow member up by 2.3%. We've got Chevron up now by 0.9%. Again, right now, Dow Industrials 49,983. Bitcoin up 11%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Hey, thanks for that update, Charlie. Charlie mentioned it, but just want to reiterate a red headline crossing the Bloomberg terminal. The Department of Justice probing Netflix tactics amid the Warner Brothers Discovery deal investigation. This, according to the Wall Street Journal. The Justice Department investigating whether Netflix engaged in anti-competitive tactics. It's probing the streaming network's proposed acquisition of Warner Discovery Studios and HBO Max streaming service. The department looking at whether Netflix's planned Warner deal could enrich or entrench its market power or lead to monopoly in the future. It's also reviewing Paramount's proposed acquisition.
Yeah, stock off its earlier highs. It just still up, though, about 0.5% here in the Friday trade. Hey, we want to get to Coursera. Company did report earnings last night. Forecast revenue for 2026 with the guidance beating the average analyst estimate. Stock has swung quite a bit today, up about 7% at its highs, off more than 4% at its lows. KeyBank and RBC both lowering their price targets on the stock today. And we just mentioned about this Warner Brothers Discovery, waiting to get this deal done. There is also an M&A story to Coursera as well. It is about a $1 billion market cap company, online education company. It is down about 19% year to date. 12%, Tim, of the float is short.
I want to bring in Greg Hart, president and CEO of Coursera. Greg joins us from San Francisco. Greg, I want to start with the merger. Carol mentioned it in December, an all-stock merger between Coursera and Udemy. What is the status of that right now? We understand it's going to close in the second part of the year. The integration, how does it go? What does it mean in terms of the customer and user experience? And who's the boss?
Thank you, Tim, for the question. So we are going through the regulatory approval process right now. Nothing to share on that front, but we're moving through the paces, and then we'll, hope to move through that and then go through shareholder approval. In terms of who's the boss, first of all, the customer is always the boss. In terms of the actual governance of the company, I will be the CEO of the combined company, and we are excited about that combination because of the opportunity to bring together, two businesses that are really quite complementary. Udemy, the companies are roughly the same size in revenue, so the combined revenue of the companies would be about $1.5 billion for 2025. With about 10% adjusted EBITDA margins pre-synergies. We also announced at signing that we would deliver $115 million of synergies post-close within the first 2 years. And so a nice improvement in the operating margin that we have as a combined company. We are focused as we go through the planning process on exactly what that integrated company and platform will look like. So how do we think about pricing and packaging and promotions? Of course, how do we think about the leadership team? And then how do we bring the companies together to really drive not only, better margins through the synergies, but also really over time drive much higher revenue growth and do a better job of addressing the massive market opportunity in front of the companies.
Greg, there have been many examples of mergers that have been announced that haven't actually gone through for a whole multitude of reasons. Some of them have been regulatory. Some of them have involved other factors. What happens if this doesn't go through?
Well, I'm very confident that it will. I mean, we operate in the education space, which is a massive space, $2 trillion plus that encompasses physical education. So K through 12, universities, vocational schools. It encompasses the online sector that we happen to be a part of, and Udemy also is a part of. And then, of course, it encompasses all the other ways that people learn today. And increasingly, that is through things like LLMs or YouTube or TikTok. We believe we have a very differentiated offering, but we are a very, very small player within that massive space. And we believe that the combination actually delivers more value to every one of our constituents. To our learners, they'll get access to more content, not only the 375 different university and industry partners that Coursera has, but the 85,000 plus subject matter experts that Udemy's content creator community has. And so it'll bring more choice, more learning opportunity. It'll be better for our content creators because they'll have access to a worldwide learner audience that's approaching 300 million registered learners across the two companies. And it's better for our enterprise customers because we're able to deliver them the breadth of that content coming from that content creator network across Udemy and Coursera.
Hey, listen, one of the things, well, first of all, I have to just follow up on the deal, the combination with you and Udemy. Is it still, though, you said you're pretty confident about regulatory, Greg, so maybe still on track to close this deal in the second part of 2026?
Yes, we've heard nothing that would, change our belief that it will close, by the second half of 2026, and remain confident in getting all the regulatory approvals we need to do so.
One of the things I thought is interesting, I always think about your business. You mentioned university, industry partners. You've got these subject experts. How are people most using it? Is it your corporate partnerships where people want retraining for their employees? Is it people on their own? Is it people who are just interested about different topics? Like, tell us where the growth is. Is it all of it or certain parts of it?
Fantastic question, Carl. So our business as Coursera, an independent company, we are 2/3 consumer, 1/3 enterprise from a revenue perspective. Udemy is the inverse. They are 2/3 enterprise, 1/3 consumer. For both companies, there is a huge focus on and growth in technology, and specifically AI right now. And so for Coursera, last year, we saw enrollments in Gen AI related content at a rate of 15 enrollments per minute. Wow. In 2024, that was only 8 enrollments per minute. And so a real burgeoning interest that I believe will continue in 2026 as well. And we are really focused on delivering not just learning, but delivering skills so that people can advance their careers. 86% of the learners who come to Coursera come here to advance their careers. And so we are very focused on delivering them skills that they can use to advance their careers and that they can demonstrate, real mastery of as they are in the workforce.
Hey, Greg, really quickly, 30 seconds. Are people in it, train, and then that's it? You don't see them again? Or how much of it is return business that the platform is sticking there, constantly coming back to learn more? And forgive me, only about 25 seconds.
Well, more than 50% of our consumer revenue is around Coursera Plus, which is our monthly or annual subscription. It's the best value for learners because they get access to all of that content. And those learners tend to stay, obviously, for longer than a single course learner might.
Cool stuff, as always. Stay in touch. Love talking with you. Greg Hart, President and CEO of Coursera, joining us from the West Coast. Hey, folks, we've got a rally underway. We've talked about the Dow going above 50,000 for the first time ever. It's staying above there. We're pretty much hovering at our highs of the session. A check on the trading day and some stocks on the move when Tim and I continue right here on Bloomberg Businessweek Daily.
This is Bloomberg Businessweek Daily with Carol Massar and Tim Stenovec on Bloomberg Radio and Television.
All right, everybody, we are getting ready to
Yes. What are we going to do?
Hello. To kick off that last hour of trading here for the week and for the day, we got a rally underway, pretty strong, up 1.75% on the S&P 500. You've heard a lot of commentary around the Dow being at 50,000, above 50,000 for the first time ever. Dow up 2.25%. Tim, Nasdaq 100, a gain of 1.9%. I do think, though, for the week overall, we've seen, I think stocks are going to finish probably down for the week. Forgive me, I should have had that up. We're down about
barely on the S&P.
0.3% on the S&P.
So we'll see. We'll see what happens. 12% higher for Bitcoin right now. I bring that up because 70,000 is what we're seeing. Almost 71,000. That comes after yesterday's 13% rout. So almost made everything back.
Yeah, S&P 500 on track for the best day since May as that tech stock rout eases. Although some of those big tech cap names, big market cap tech names, still under some pressure. So we'll be continuing to follow that.
I'm Tim Stenovec along with Carol Massar. Let's take a look at some stocks on the move today. With us is Bloomberg News cross-asset reporter Denitsa Tsekova.
Patiently waiting for us.
Let's start with one of the few stocks that is under pressure today, and it's a mega cap.
Yeah, one big tech mega cap that is under a lot of pressure. Amazon, we've been talking all about it since the earnings. The ticker is AMZ, and stock is down more than 7%. Really, we're seeing such a big recovery among all the losers of the last few days, but this is not the case for Amazon. The stock is already down 10% year to date. The number that everyone has been talking about is that $200 billion investment, data centers, chips. And obviously, investors are jittery about any AI spending, especially in the last few weeks. We saw a similar reactions to Microsoft, Alphabet. That said, Microsoft is up today. But what we saw is that the CEO is saying that the money will go to the cloud business, to the Amazon Web Services cloud business. But the important number that everyone is looking at is their projection for profit. It was about 16 to 21 billion, and it's lower than what analysts were expecting. So obviously that's the big issue investors have been looking at. And the moment it's denting profits, you can see that investors are really punishing the stocks. Amazon has been doing a lot of layoffs, 30,000 since October. That's about 10% of the corporate workforce. But the company has had a pretty rough stretch and is not caught in that big recovery that we're seeing today and as the buyers are emerging.
I got to say, I think it's safe to say that Mark Mahaney over at ISI Evercore, a pretty positive spin on these hyperscalers, big mega cap tech companies in terms of the spend and vying for dominance in this world.
If you missed that interview, check it out on our podcast feed.
We like to do shameless plugs. Why not? Matt Miller is not the only one who can do them. All right, so Amazon, AMZN, of course, is the ticker. Let's go to another one, a subject that we've been talking a lot to, and that is the crypto universe.
Complete reversal, and crypto-linked stocks are on the top of this. They're obviously Bitcoin retracted. We almost had like a 50% drop from its peak. Now we're around 70,000. And all the companies that are associated with cryptocurrency pretty much move in line with that bet. We're looking at Strategy, Mar Holdings, Coinbase, Robinhood. All of those names, really big reversal today. Leading the gains is a company that just reported earnings, MicroStrategy. The ticker, of course, is MSTR. The stock is up 25% year to date. But this is not about the earnings report. Actually, the fundamentals from the earnings reports were pretty weak. The Bitcoin hoarding company confirmed a net loss of more than 12 billion. But obviously, investors are not looking for that. It's a very strong sentiment day. That said, the company is now down about 12%. The company, Sayware has said the company faces no margin calls. Everyone is asking, obviously, are they going to sell Bitcoin? So far, we're not seeing this being the case. But another trend we're not seeing is the company is not buying Bitcoin at the moment. So perhaps that is telling.
But it's like on sale for them. That's what's
exactly. Perhaps. If you're a believer, right, this would be the time.
Yeah,
this is an opportunity.
If you liked it at 100, you should like it now, right? It makes sense.
If you liked it at $125,000, you'd love it at $70,000.
Perfect.
Unless
you don't have the money, or I don't know.
Or you think it can go even down more?
Good
even
point.
lower?
Who knows what way it goes?
You're into cosmetic companies, aren't you?
Yeah, especially if they're moving big one way or the other. I don't know what to say.
I didn't know why I did that to him.
That was a reluctant no.
That was an uncomfortable pause. Yeah. Well, we're in this business. We all have to wear a little bit of makeup. Yeah. Should we talk Coty?
Coty, it's an interesting one. So the brands under it, Kylie Cosmetics, Gucci, CoverGirl, Sally Hansen, there are quite a few different ones, even if you haven't heard the name. Shares are sliding though today. Stock is down 15%. The beauty company scraps its fiscal 2026 outlook. This is not the first company that's reacting like that. We saw a similar reaction by Estee Lauder just yesterday. The stock actually tumbled 19%. Beauty industry is obviously an interesting space to watch when it comes to the economy. So that kind of weakness we're seeing could be telling indicator. The company said that they're seeing heightened promotional environment and weakness in its consumer beauty business. They recently got a stake in hair care brand Vela. So it's an interesting company to watch under a lot of pressure, and everyone is looking at the consumer and what's been happening to it, and this perhaps is a good indicator that maybe some of those discretionary spending is not doing so well.
I don't know. When you don't have a lot to spend, they talk about, you have money to buy a lipstick because it's a small purchase. Denitsa, thank you so much. Stock Movers Podcast, check it out. 5-minute episodes, big winners, big losers in the stock market. Find it on Apple, Spotify, or anywhere you get your podcast.
Speaking of big winners, we're talking about the semiconductor industry on Bloomberg Businessweek Daily. Ian King joins us next. This is Bloomberg.